You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we'll be discussing ASOS, Deliveroo, Dechra Pharmaceuticals, Hotel Chocolat, D Wetherspoon, Kraft Heinz, that's all of them actually, D Wetherspoon and Kraft Heinz. So I should start by saying that ASOS is the only company that's actually released results in the last week that we're covering. For the rest of them, because we've just had earnings season, there's quite a few companies where we wanted to talk about them, but we just didn't have time to fit them in without making the shows even longer. So we're now going back to some of the companies that we didn't get to talk about that we would have liked to. All right, shall we kick off with ASOS, John?
Yeah, so ASOS, Sam. I think we all know what ASOS is, but do you want to just give a bit of background?
Yeah, so ASOS is the online clothing retailer. That's pretty much it, isn't it, I guess?
It's listed on the alternative investment market.
It is, yeah, it's one of the bigger ones on there. Yes, it's 5.3 billion market cap. So it'd probably be pushing FTSE 100 if it was actually listed on the FTSE.
Oh, yeah, I think it would be.
Yeah, but anyway, they've come out with 6-month results to 28th of February 2021. They've announced that revenues increased 25% to 2 billion for the first half, ignoring the impact of exchange rates. And they've said that reflects a 25% rise in retail sales, with sales rising double digits in every region. Growth was particularly strong in the UK, and that fed into record underlying pre-tax profit of 112.9 million, including a 48.5 million benefit from the pandemic. They said they expect this tailwind to reverse when tourism and hospitality restrictions lift. In the UK, retail sales rose 39% to 800.4 million, and ASOS gained online market share because of the lockdowns. There was strong growth across face and body, activewear and casual wear. There was a reduction in occasion-led shopping and average basket value decreased, but this was offset by an increase in new customers. Active customers have reached 7.8 million and rose 15%. Profits were helped by more deliberate shopping habits, which mean customers are less likely to return items. Retail sales were also boosted by lockdowns in Europe, rising 18% to 580.1 million. Trends were similar to the UK in that average basket values fell 4% because of a shift to lockdown categories, but active customers rose by 700,000 to 9.9 million. France and Ireland performed particularly well, while Spanish sales fell because of adverse economic conditions for ASOS demographic. The US faced headwinds because ASOS relies more on occasion wear in the region. There were also issues with stock availability. However, sales still rose 16% to 225.7 million, and they now have 3.3 million active customers in the US. Increased basket value helped retail sales rise 16% in the rest of the world region, reaching £313 million. Gross margins for the group fell from 47% to 45%, which they put down to exchange rate movements and increased freight. Operating costs rose 9% to 780.3 million, with the biggest rise coming from marketing costs. However, operating costs as a percentage of sales fell from 44.8% to 39.5%, resulting in an improvement in underlying profit margins from 2.2% to 5.9%. Net cash fell 315.5 million to 92 million following the acquisition of Topshop assets in February. And they've said the integration of the Topshop brands is going to plan, with one-off integration costs expected to be around £10 million. In terms of the valuation, the company is currently trading at a PE ratio of 38, and that compares to a 10-year average of 53.7. John, thoughts on ASOS and these results?
I think given that occasion wear and people going out has obviously been well down over the last year, I think the results are pretty impressive. I suppose it is factored into the price. You mentioned the Topshop acquisition. I think that made a lot of sense. How much do you say they paid for that?
£330 million.
330 million. And in terms of the growth, compared with the historical growth, is it slowing?
Growth was, I think, what did we say, 25%. From 2018 to 2019, the growth was actually only 13%.
It's more attractively priced now than it was back then, really.
Well, yes, growth was was decelerating back then. From 2017 to 2018, the growth was 25%. And from 2016 to 2017, the growth was 33%. I wouldn't say it's slow. It was slowing, and then it looks like it's re-accelerated.
Yeah.
But I think a lot of it probably depends on the US at this point, because what did they say? Like 7 million people have an account, but that's 1 in 10 people. And I don't know what that is in terms of adults either, which will be an even higher proportion. Whereas in the US, the saturations is more like 1%. So
do you think it's going to be able to crack the US market? I suppose that's the bigger thing, because if it's reaching sort of peak in the UK, sort of peak saturation.
I don't know.
Yeah.
I think that's the difficulty with like brands like this, because it's a bit like Fever Tree, where if they crack the
I
US,
was just thinking that.
The valuation's a no-brainer. But how do you actually determine whether or not they can do it? I guess you could look at the track record and you could say, well, they've obviously done a good job in the UK and Europe, but that's not a guarantee of success in the US. And it's not like the US is there for the taking. I'd imagine it's a very competitive market. But I guess if you were looking at management's past performance, I think you'd say they're doing a good job. So maybe you would trust them to keep growing.
Yeah.
I think at a PE of 38, I don't know, maybe you could take the view that how much more do they actually need to grow? If they were to grow slower but start increasing the efficiency, those operating margins, although they've improved, 5.9% operating margin isn't very high.
No, it's more like a supermarket.
If they could get that up into the high single digits or low double digits, and they could carry on growing at a reasonable rate, then that PE soon starts to come down, doesn't it? So I can see how it would work out well for someone if they were buying it for that reason. But
how does it, I mean, not that we're going into detail on Boohoo today, but how does it compare with Boohoo's valuation at the moment?
Sure, when we did Boohoo last time, I think they were fairly, I think Boohoo was about 4 billion. Yeah, Boohoo's 4.4 billion. So ASOS is about 20% bigger than Boohoo.
Yeah.
Boohoo's more expensive. Boohoo's growing faster. Boohoo's growing at more like 50% a year.
Do you see any other headwinds? You know, like there's the ESG side of ASOS and Boohoo, which some people question what the supply lines are like and whether everyone's receiving sort of a fair pay deal. Certainly when you get down to sort of the manufacturing abroad. Do you think that's an issue for ASOS?
I don't know. I mean, I'm not the customer. It's the problem. So if I'm being completely honest, when I'm shopping, that's not something I would check. It's not something I really think about. I've never bought anything on ASOS, so
no. That's right. I'm the same. I haven't bought anything on ASOS. I think it's an interesting company. It's something that I probably, you know, over the last 5 years just haven't been brave enough to seriously look at and consider.
I think my biggest issue of it is it's been a while since we looked at it. But I remember last time when we looked at it, we looked at Boohoo not too long after, and I remember liking Boohoo more.
Yeah. But
I'm sure we'll revisit Boohoo as well at some point. They must report fairly close together, so I imagine Boohoo will be on the list fairly soon.
Yeah, so we can maybe come back to it then.
Yeah. So, should we move on to another expensive company then, John?
Another expensive company. Which one would that be, Sam?
Deliveroo.
Okay, I wasn't sure whether you could say Hotel Chocolat, but that
could count as expensive as well.
Okay, lots of expensive companies today. Well, the last one might not be too expensive, but yeah. Okay, so Deliveroo. So you may have heard of Deliveroo's, or you probably have heard of Deliveroo's float last week, and been known in the papers as Flopperoo. So it floated at £3.90 a share, which I think gave it a market cap of about over 7 billion. The first day of trading didn't go as hoped, and it's now down to, I think it was down 28% on the first day. And as of closing today on the 12th of April, it was down 35%. So it hasn't been a good start. It hasn't gone as hoped. The market clearly thinks it's overpriced, and there's been a lot in the news about, I suppose, the workers' rights and how the sort of gig economy might be more tightly regulated, which of course is Deliveroo's whole operation. It's also that, I suppose, not being the US, there's perhaps in being a European, predominantly UK operator, that could be a big issue if the legislation here changes and if Deliveroo riders are classed as employees rather than self-employed. So I guess that's sort of hanging over the company. Had you had a look at any of the numbers, Sam?
I've had a very quick peek.
So I mean, looking at it, revenue growth has been impressive, but it's not, not turning into earnings really.
No, so it's revenue. So just context: 2018 revenue 476 million, 2019 771 million, 2020 1.19 billion. Gross profit has increased in line with that. Gross profit 2018 91 million, 2019 188 million, and 2020 356 million. Gross profit margins of about 30%. I mean, that's a very low margin, isn't it? Which I guess makes sense because you're paying a driver to go and deliver stuff. But
I mean, it is that
gross margins aren't particularly attractive.
And it is that really, it's a different business model to Just Eat, which doesn't do the deliveries.
No, and it was actually one of the things that I disliked about Just Eat. I didn't like the fact that they were going into the delivery.
Yeah,
I just don't see the attraction. It just ends up being a commodity, or I think it will. It's just a race to the bottom. If you're a restaurant, if Deliveroo are going to deliver it for one price and then Just Eat come along and say, we'll undercut them by 10%, you can just switch to Just Eat. I don't think you really care until you get to a point where one of the platforms is just so dominant that you have to be on there. I think people will just chop and change, and I think they'll just end up undercutting each other, and it's just a bit of a race to the bottom.
Yeah, and I suppose that for me, that was a reason that I mean, it's tempting to look at the IPO and wonder whether it's going to pump for the first day, the first week, but that didn't happen. And as a business, it's not one that I really like. I think it's an impressive service. When you've got it on your iPhone and you can see the delivery driver coming, it's very slick to use, but that's it. And I wouldn't sort of opt for it. It's the restaurant rather than the delivery service that I'm going for.
Yeah, it's very competitive. I think if it does ever reach profitability, I think it'll be a very low margin business because you've got that cost of having to, it's not like software where, like, if you sell an extra piece of software or something, it just goes straight to the bottom line. Someone needs to go out and deliver that. And yeah, I don't like it.
What do you think on the sort of the employment issues that might be involved and what that could essentially do to Deliveroo's bottom line?
The City of London, they've been quite aggressive towards Uber, but I think that's more to that. A lot of that's been to protect the black cabs, whereas I don't think there's any equivalent of black cabs that Deliveroo is hurting. So I don't know if they're maybe less likely to get criticised for it, if that makes sense, because there's no one to protect.
Yeah. It would be a worry. I mean, quite apart from everything else we've discussed, that would be a worry for me and what that would do to Deliveroo's bottom line. Because I mean, it's bound to get more expensive. And if this is as cheap as you can get it.
What bottom line?
Well, okay. Well, okay. What might be the future bottom line? Or even, put it this way, getting to the bottom line is going to be made even more difficult by that. So no, it's not something I like. I'll be interested to follow it, of course, but yeah. And it's interesting because they priced it actually at £3.90 a share at the bottom end. I think there was sort of talking about going up to 9 billion.
So it's 4.3 now.
It's 4. And I suppose this is the biggest float that we've had in years, but it's been a flop.
It's less than 4 times revenue.
Yeah.
Problem is that price of sales, it's not really as useful when it's such low gross margins, is it?
Yeah, because I suppose that would be a difference between some of those companies you'd have looked at, the last couple of months, like Etsy.
Well, yeah, it is. Yeah, I mean, Etsy's gross margins, I don't know off the top of my head, but they're at least 60%.
Yeah.
It does make a big difference because then you look at it and you can say, well, when it's got to X size, whatever size you think you can get to, those gross margins, you've got a good idea what they'll be. They're probably not going to change. And then you can say, well, how much of these operating costs, a lot of these shouldn't increase proportionally with the business. And you can then start playing around with the figures and saying, well, how profitable could this be if it gets to the size I think it could? And the problem is, if you do that with Deliveroo, I think firstly, it's very difficult estimating the size because it's a very, very competitive market. And then if you do that, The answer might just be it might not be very profitable because it's just going to get undercut by Uber Eats and Just Eat.
I really don't like it.
No.
I like the app, but I just don't like the business.
But it's like Uber as well. That's a really good product, but they don't make any money. And maybe that's part of the reason why consumers love it, because it's just such a great value proposition.
That's right. Yeah. And it's interesting, actually, because I usually make a point, this is just not anecdotally, but make a point, certainly when I'm on Uber, in Ubers, and this is whether I'm in like the US or the UK. And I always ask the driver, do you like working for Uber? And I haven't come across a single one who doesn't like it. And I mean, I've been in, it must be like hundreds of Ubers. And they all say they like the flexibility. They like that they control the hours. I appreciate that black cabs are a different category altogether. But if you compare it with other private hire companies, they seem to prefer it because essentially they're their own boss and they seem to prefer that. And I suspect, but I'm not 100%, that some of the other private hire companies treat them as self-employed anyway. So it's just Uber take the cut and then the rest is yours, rather than your private hire company taking a cut and the rest being yours. But they seem to, they anecdotally, they seem to like it. But it's certainly perhaps different to what's represented by some of the unions in the press. But that's just my experience. So obviously not sort of comprehensive. But no, I don't know how it is for the Deliveroo riders, I should say. What do we have next, Sam? What's the next company that you've got?
Should we do D Wetherspoon?
Okay, so this was actually, we had a listener request for D Wetherspoon. He's a loyal customer. He lives around Oxford, and he's been interested in seeing how the company's done and how we see it going forward.
I'll jump. So they've released their 6-month results. The results are pretty much as you'd expect, really. So revenue of £431 million was down 53.8% from the prior year. Like sales are in line with that, down 53.9%. Before the impact of IFRS 16, which is just to do with the accounting treatment of their leases. So we'll look at the pre-IFRS 16 figures just because then you actually get the best comparatives. They had a loss before tax of 46.2 million, that compared to a profit of 57 million last year. Operating loss of 20.7 million compared to a 76 million profit last year. Earnings per share loss of 36.4p compared to 44.3p earnings per share last year. So yeah, I won't go through any more because it's as you'd expect, really. I mean, they've been shut, so there's not really anything they can do. But there were actually a number of interesting slides, actually. So one was it showed the like-for-like sales growth year on year from 2011 up to the current year. And it's positive every year. So 2011 was the worst year, excluding the current year. 2011 was the worst year with 2.1% like-for-like sales growth. Then it was 3.2, then 5.8, then 5.5, then 3.3, then 3.4, then 4, then 5, then 6.8 in 2019. I thought that was quite impressive, that they've been able to consistently boost that figure prior to the pandemic, and then it's obviously just fallen off a cliff. The average weekly sales per pub have trended in the same direction. So they've increased from 31.1 thousand on average in 2011 to 48,000 on average in 2019. They showed the change in sales mix in the business. So in the year 2000, 6% of their revenue came from machines. So that'll be like the fruit machine, the fruities, won't it? It'll be those. That's dropped to 3% in 2020. 18% of the revenue came from food in 2000, and that's up to 36% in 2020. And 76% of the revenue came from the bar in 2000, and that's down to 60% in 2020. So I think that's quite interesting, seeing the food side of the business evolve over time.
Which to me seems quite a positive thing.
It does, yeah. Yeah, I'd say so. They highlighted that around 99% of the workforce furloughed throughout the recent lockdown. Which is, again, we should expect.
Yeah.
They've shown the movement in net debt.
What level is it at?
So closing net debt at the end of the half was 811 million. And that compares to a market cap of 1.77 billion. But if you look at the last normal year of profit, they made £72 million of profit in 2019. So it's 10 times the level of profits. I think they can comfortably pay it, basically, certainly whilst interest rates are low. Do you have a different thought on that, debt?
No. I mean, it's higher than I'm sure they'd like it to be, but again, it doesn't sound outrageous.
Oh, they've highlighted that 64% of the properties are freehold compared to 35.6% being leasehold. So that's obviously very good. They've highlighted that they've got 39,416 employees, of which 15,032 are shareholders of the business. In terms of the outlook, they didn't hold back.
Yes.
I'm sure you can imagine. So they said, Wetherspoon and its employees, along with the hospitality industry, have worked very hard to comply with ever-changing government guidelines. It is disappointing that so many regulations, implemented at tremendous cost to the nation, appear to have had no real basis in common sense or science. For example, curfews, substantial meals with drinks, and masks for bathroom visits. The future of the industry and of the UK economy depends on a consistent set of sensible policies based on scientific evidence rather than political expediency. And finally, they gave a 10-year overview showing the number of pubs. So that's in 2011, they had 823. That peaked in 2015 at 951, and it's now at 872. However, the total turnover has been increasing. So that was 1.072 billion in 2011, and that reached 1.819 billion in 2019 before it then fell off a cliff. In terms of the valuation, if you use the normalized 2019 earnings and treat them as normalized, it's at a PE of 19.7. If you were to use the adjusted earnings for 2019, you'd get a normalized PE ratio of 18. My view was it's not cheap, but to me, there was a lot of stuff in there, especially when you look at how they're increasing the revenue per pub, how they're improving the sales mix, so they're not as dependent on the bar over time. They own most of the pubs. I thought 18, if you take it a normalized PE of 19 for a quality business, I think that's pretty justified. The only thing I'm not so sure about is the debt, although I do think it's manageable, but I don't think it's an outrageous valuation.
I know, and I suppose a lot. I don't think it's outrageous. I suppose that there is uncertainty as to what the rules are going to be going forward, and are they still going to have the social distancing, in June? And if they are, then how does that work for Wetherspoons and packing people into the pub? I think that's sort of, quite a big issue. If it were going back to completely normal and you were sort of scrapping all of that, then it doesn't seem at all unreasonable to pay that much for, like you say, a quality business. The other thing that I'd be a little bit concerned about with Wetherspoons is, I suppose, how much more can it grow? Because it feels like there is a Wetherspoons on every corner, and whether it's sort of reached saturation point in...
Well, the number of... Well, I can't remember what year I said, but the number of pubs has already peaked, and even before it was coming down. It's just the fact they were able to get more and more out of each pub. You see, like, statistics about how regularly pubs are closing. I don't know if maybe as more and more competitors close, they will continue to get more from each pub, and they don't need to be everywhere because there's always a Spoons nearby. So I don't know if that's part of it. Just the decline of the industry generally is maybe giving their per pub sales a big boost.
That's right. And it's not like a traditional pub. It's not just about selling pints. I suppose Tim Martin started by sort of, introducing breakfasts. People go to Wetherspoons for a coffee. He, cuts costs in things that you wouldn't necessarily think would be wise, but have worked very well, like, not having a Sky Sports subscription, which, typically pubs might spend a number of thousands of pounds on every year, but he just cuts those out and makes the business very efficient, or much more efficient than a traditional pub, and squeezes as much out of each pub as is possible.
They must be the lowest cost operator. I think of anyone running a leaner operation. That's right.
I don't think they play music in Wetherspoons either, so there are no royalties going out for that. It's as lean as it comes. I mean, I'm a proud Wetherspoons customer. I think the product's great.
I do like it. I think last time we talked about spoons, I think we were a bit more critical of it, but I think at that point it was more how, like, you've no idea how long this is going to go on for. You don't know what it's going to be like after. Whereas I do feel like now it seems like the end is in sight, and I think they'll get back to normal.
I think when we've talked about a few companies like this, and it was pre-vaccination, but before those Pfizer results came out last year, you just didn't know what the normal was going to be. And for these sorts of companies, what had sort of maybe at that point become the new normal was sort of crushing. They could really no longer operate. Hopefully, in the direction that we're currently, or the trajectory that we're currently continuing at, you could get back to a situation where it's normal, and actually Wetherspoons, if it gets back to pre-pandemic, it's actually maybe cheaper at the moment, or certainly reasonably priced. It's priced
as if the pandemic's finished, right? That's the sort of price I'd expect it to operate at. It wouldn't the sort of level I'd expect it to be priced at if it's the earnings were normal, basically. So I think people are taking a view, well, the end's in sight, and we think we know what it's going to look like. It's still not quite where it was pre-pandemic, but it's not far off now.
After those Pfizer results came out in the autumn, this is the proof of concept with the vaccines. I mean, now the shares are up nearly 80% in those 6 months.
We should have bought it when we were taking it off last time.
Oh, well, I mean, I suppose this is it. And there's a lot of sentiment, driving markets. So
that's what we should have done with the fantasy portfolio. We should have gone 50%
spoons,
50% shell.
Yeah, that's right. The companies that we liked least back then.
Right, so should we move on to Hotel Chocolat next?
So we've got another AIM company, Hotel Chocolat. So Hotel Chocolat is, as you might imagine, a chocolate retailer. Its interim results were out on the 26 weeks ended 27th of December 2020. Some of the highlights: revenue was up 11% to 101.9 million, compared with the first half of 2020 being 91.7 million. Underlying EBITDA up 2% to 24.9 million. Profit before tax up 3% to 15.5 million. It's got a strong balance sheet with a net cash at the period end of 47.6 million. Earnings per share of 9.7p. Other highlights: the strong sales growth reflecting the growing brand appeal in the UK, US and Japan. UK sales grew by 12%, driven by increased multi-channel flexibility, with online growth more than offsetting for their physical retail sales, which is obviously due to the closures and the tier 4 restrictions that we had here in the UK. They comment that their UK customer database grew by 38%, and they had another 600,000 active members. The US customer database grew by 170% and Japan by 900%. 51% of UK sales in the period from the direct to consumer digital, so their sort of online sales, subscriptions and online experiences. And they comment also that the pivot to digital-led growth in the US, with sales growing 22% in the second quarter, and that they're expanding their capabilities in the US to fully capture that market opportunity. And the Japanese joint venture sales to consumers grew 228%. Wholesale sales by the group to the joint venture contributed 1 percentage point to the group's year-on-year growth. Underlying gross production margins stable. The impacts of the COVID-19 response drove an overall reduction in the gross margins of 400 basis points year on year, with the scale of the headwinds expected to diminish once the current ongoing restrictions ease. Overheads reduced to a percentage of sales, 160 basis points lower year on year, mitigating the additional variable costs from an increased digital and wholesale channel mix. And they comment on the sort of the ESG side of the business, continued progress on sustainable business goals, development of a new gentle farming approach for cocoa growing, investments in people, created over 130 new roles, achieved the highest ever team engagement survey results in their annual survey, and the proportion of recyclable packaging rising to 93%. And Angus Thirlwell, the co-founder and chief executive of Hotel Chocolat, said, "The Hotel Chocolat brand stayed strong during a difficult period for all of us. We certainly kept the chocolate flowing thanks to our online capabilities and multi-channel expertise. We recorded superb results in the UK, US, and Japan, despite COVID-19 restrictions affecting all our physical locations. We achieved sales growth during those periods when all UK physical locations were closed, demonstrating the brand's appeal to our loyal customers and our flexible business model. Databases of active customers grew substantially in all three markets, underpinning our confidence of growth in the years to come. In the UK, our multi-channel model truly came of age, and excitingly, both Japan and the US firmly stepped up from the test and learn phase into growth and scale. Total brand sales through direct-to-consumer partner channels combined increased 16% year on year. Huge thanks go to all the Hotel Chocolat family who worked tirelessly and safely to creatively and adapt the business and deliver these results. We know that we all played a role in maintaining morale and bringing happiness through chocolate in all the countries we operate in. We look forward to building the Hotel Chocolat brand further as we move closer to our goal of becoming the leading global direct-to-consumer premium chocolate brand." And revenue was 101 million, up from 91 million back in 2019, and operating profit up to 16.4 million from 15.8 million in 2019. Sam, what do you think of Hotel Chocolat as a business and a brand?
I thought, given that so much of their imprint is physical, I thought those were pretty decent results. I think they are very much at the moment a UK-based business. I know they talked about the US and Japan, but in the US, they've only got 4 locations. And in Japan, that's very small as well. And it's 80% owned by local management. So they've only got 20% of it. If you use the 2019 results and treat those as normalized earnings, you'd get it at a PE ratio of about 43. So you are really, it's similar to ASOS and Fever Tree, which we mentioned earlier, where you're paying for the overseas growth. The only thing I would say is they've only got 96 stores in the UK, and I thought it'd be more. So I actually don't think they're at saturation point yet in the UK. I think they could quite reasonably have more than 96 stores. But you are mainly paying for the overseas growth, and I don't know how easy it is to deliver on that. I don't know whether or not that's something where there's already strong brands in the US and Japan and wherever else they decide to go, or if there's not that premium chocolate market that they're going for. I don't know enough about it, so I find it very difficult to actually judge. What about you?
Yeah, no, I'd probably be in a similar position to you, because I suppose from the UK market, Hotel Chocolat really took over from Thornton's, because Thornton's used to have that sort of a similar brand, I suppose, to Hotel Chocolat, and it was, it had sort of bricks and mortar stores, and it did have a more premium image. And I think Thornton's really debased it when they moved into the supermarkets and they started selling all of their products in the supermarkets. And now when you think of Thornton's, you don't really think of it as a premium brand, I wouldn't have said. So I think I like the Hotel Chocolat brand, but I don't know how strong it is going to be and whether they're going to be able to, successfully expand in, for example, the US or Japan. It's I suppose, like you say, it's fine if they have a handful of stores, but if they're really going to push that, and at the current valuation, that's what's priced in, isn't it?
It is, yeah. 43 times earnings isn't. It's not cheap, is it?
It's not cheap. And I suppose if you were to say, would it be Fever Tree, Hotel Chocolat, or ASOS, if they're similar valuations? I don't know. I would be probably more tempted to go with a Fever Tree.
I just couldn't tell you. I've got no. I mean, the only thing with Fever Tree is they've already got somewhat of a presence in the US.
Yeah, but it's very difficult to tell. But I suppose the upside, if any of them crack the US, I mean, it's huge. And you might be willing to pay that price for that potential return.
Maybe go for all three and just do a basket and just
yeah.
One of them cracks it'll pay for the OT.
Well, that is true. It's definitely. I think it would definitely be a bumpy ride.
I think that is like there is an element of like that's if you were to look at those kind of businesses, because we've done the same thing with ASOS, Fever-Tree, and Hot Chocolate. We said looks like a great business, management are doing a great job, but we've got no idea whether or not they can do it in the US. And I think it probably does make more sense actually if you were to say, well, there's quite a few of these UK companies that are starting to try and expand abroad. Maybe you can't decide which, but if you like all three, you could just say, well, two of them might fail.
Yeah,
that's probably a better approach, because I don't think, unless you know a lot about the chocolate industry and the US market, I don't see how you make that decision any other way.
No, that's right. I mean, the shares since floating, I think it was back in 2016, they're up 100%.
We'll have to make a little index. We could call it like Brits Abroad or something.
Yes, that's right.
We can see how it does.
Yeah. No, it's because I suppose we don't have a huge number of growth companies over in the UK. So these ones, they are exciting businesses to follow. And obviously you want them to do well.
National treasures.
Well, I think yet to be seen. Yeah, or they'll have to,
Hotel chocolate is going to be like McDonald's in 20 years.
Yeah.
You want on every street corner.
But do you want it on every street corner? Is that what they've got it's the premium image, isn't it? The premium brand.
But I do think they could have more than 96 UK stores. That does seem
Yeah. The other one, which we won't cover this week, would be Brewdog. I think that would be an interesting business to have a look at, which is mainly makes Indian IPAs, and that's got its IPO coming up, I think. But again, it's that, I mean, I think 5 years ago, it was two friends brewing in the north of Scotland. And now it's, I think, expanding in the US. They certainly had a lot of private equity input. And now I think it's actually going public. But I think that's another one. I don't know what the valuation will be, but I imagine if it's, 40 times, that's probably cheap.
Yeah, you might not even get it for that. Depends on the
characters now. Yeah, fine. Okay, so next company, what have you got, Sam?
Dechra, I don't know how you pronounce it, Pharmaceuticals.
And this was a listener request.
This was Brummy Investor requested this one. So they've released their 6 month results to 31 December 2020. For anyone who doesn't know Dechra, which I imagine is most people, they're a pharmaceutical company, but it's animal pharmaceuticals rather than human. So they've got a long history in the veterinary health market, and they've grown into a global veterinary pharmaceuticals and related products business. Their expertise is in the development, manufacture, and sales of marketing high-quality products exclusively for veterinarians worldwide. More recent changes, including a number of highly successful acquisitions, have helped shape the current business. However, the heritage has undoubtedly contributed to Dechra being the successful business that it is today. So they do pharmaceuticals for horses, food-producing animals, and companion animals. Different types. They've got lists on the website: anesthesia, cardiology, dermatology, diets and nutrition, endocrinology, exotics, fluid therapy, ophthalmology. Oh, this is right up your street, isn't it? It's just a different animal. That's all. Not
just a different animal. So the eyes.
And then internal medicine. So they've come out with their 6 month results. Ian Page, CEO, has said, despite 2020 being one of the most challenging years in Dechra's history, it's pleasing to report that the calendar year ended strongly, resulting in excellent performance in the first half of our financial year. So the highlights include strong cash conversion of 105.3%, Ocernia and Mirataz product acquisitions performing strongly and ahead of expectations. Revenue was up 21.8% at constant exchange rates to 299.8 million. Operating profit was up 32.7% to 80.8 million. And the operating profit percentage increased from 24.6 to 27. The diluted earnings per share were up 24.7% to 54.28p a share. And those are the underlying figures they've given rather than the reported figures. So the reported figures are actually even better. So if they've adjusted it down, they must be right. In the operational review, in the European pharmaceuticals segment, They've said in the period, our total European pharmaceutical segment net revenue increased by 21.7%, including the acquisition of Ocernia, which was acquired in July 2020, and the benefit of the pre-Brexit inventory build of £7 million. Existing net revenues, excluding third-party contract manufacturing, which Dechra is strategically exiting, increased by 18.6%. All European countries, including the UK, performed strongly, with good growth being delivered in all of our product categories. Our international business, which is reported in this segment, also performed well through our business in Australia, New Zealand, and Brazil, and also through our distribution partners. In the North America pharmaceutical segment, they've said in the period, our total North American segment net revenue increased by 21.9%, including the acquisition of Ampharmaco, which was acquired in August 2019, Meritas, acquired April 2020, and Ocernia. Excluding acquisitions, existing net revenues increased by 14.8%. Growth was almost entirely delivered by CAP performances. I think it's companion animal products.
Is that a dog?
It could be a cat.
Sorry, carry on.
Growth was almost entirely delivered by companion animal performance, as we have little presence in nutrition or the FAP, that must be farmed animals, market in North America. The strong sales uplift must be considered against a soft comparative period in the prior year where supply issues detracted from the performance. The majority of our key products are now back in supply. However, the ophthalmic products, which have been out of stock for over a year, are still in the process of being transferred to a new contract manufacturer and are taking longer than expected to return. In the product category performance, they've said companion animals, which represents the majority of our business at 73% of group turnover, grew at 27.3% over the corresponding period last year. This growth can be attributed to strong market dynamics, excellent virtual customer engagement, an improved supply chain, and the continued benefit from disintermediation of products from the Levat acquisition from 2018. Farmed animals, 12.3% of group turnover, reported growth of 10.6%. Our Solustable range of water-soluble powders continues to outperform with exceptional growth in Belgium and Spain. Equine, 7.6% of group turnover, delivered 16.8% growth, which was ahead of our expectations. This growth can be attributed to improved flavoured versions of our leading brand, Equipalazone, and the addition of the Levat range of equine products, strengthening our overall portfolio. Nutrition, which represents 5.3% of group turnover, delivered growth of 10.7% in the period. The growth in our specific branded range of pet diets has been driven by a new business unit that has given additional focus to newly positioned products, and also by the launch of a new range of organic diets. They've said the research and development investment increased by 12.5% to 15.1 million, but the spend as a proportion of revenue has actually decreased from 5.5% to 5%. However, they do expect the spend to be weighted towards the second half. They've highlighted that global trends include increasing pet ownership, people spending more time with animals, and humanization of pets, and veterinary practices continue to operate. They've talked about the pipeline. They've said the Dechra team continues to be effective. Numerous minor registrations in major territories and international markets. Zagreb Vaccine Development Laboratory received GLP certification. Dossier for novel canine sedative to be submitted in second half. Accident dog and cat proof of concept studies delivering favourable results, and accident cat contract completed. So I struggle to evaluate the pipeline, and that's one of my main issues with this would probably be my main obstacle. So in terms of the valuation, the company trades at a PE ratio of 38. However, that'll be based on last year's figure, so that won't include the increase in earnings per share. So underlying earnings per share increased by about 10p a share. So adding that to the adjusted figure from last year, it's probably trading more at a current PE ratio of 34 or 35. The business is valued at 3.88 billion. I like the business. It's not a business I ever would have looked at on my own. I liked it. I thought it looked really, really interesting. My only issue was that I struggled to evaluate the pipeline and the products. I don't really know anything about it, so that makes it quite difficult for me to make a decision. So it regrettably goes in the too hard pile, because I don't think it's worth the time it would take to dig into getting to understand the products. But it is with regret it's going in the too hard pile, because it does look like a good business. What are your thoughts, John?
I would say, well, similarly, and I mean, I suppose the principle in general with pharmaceutical companies, and I don't know whether this will possibly applies for sort of pet pharmaceuticals as well. But yeah, if you can examine the pipeline and you actually have sort of industry knowledge about it, then it's those drugs, if they come off and you've got the patent on them for however many years, you've essentially got a monopoly and you can sort of name your price, and there can be huge, you know, if there's a blockbuster drug, huge earnings from it. And if you have a series of those, you know, the share price and the earnings can go through the roof. Obviously, they're very expensive. And if they fail, you know, in the latter stages of the trials, that's a huge loss. There's lots of R&D spending. But if it comes off sort of big time. And yeah, I wouldn't have the knowledge either to really be able to dig into those products and say that I knew what it meant, or, you know, what it was like, where it was placed in the market. I suppose on that basis, you would be relying on other people's analysis, really. And probably this might be where if you're, if you're an institution and you have a team of analysts, these businesses would be easier to look at and easier to evaluate. But as an individual, they're certainly more difficult to understand as, you know, as someone who's not in the industry.
I thought the growth was very impressive, though. And if you actually look at the last 5 years of financial statements, revenue in the past 5 years, so 2016 to 2020 inclusive, revenue's more than doubled from 247 million to 515 million. And that has fed through to earnings per share as well, with basic earnings per share more than doubling from 14p to 32p, adjusted earnings per share more than doubling from 42.95p to 92.5p. It looks like a very good business.
What did you say the market cap was?
3.88 billion, so it's FTSE 250.
Yeah. Fair size.
It is, yeah, but I guess they seem to be making inroads into a lot of other areas and other countries, and if that continues, 3.88 billion.
Yeah, I appreciate it.
It's not that big at all, is it?
No, it's yeah. You compare it with a Pfizer. A Pfizer for pets.
And because a lot of it's like acquisition based, and they've already got inroads in all these countries, I could see it a lot easier than I see it with some of the other companies we've talked about today, where that blueprint for the international expansion is already in place, really.
Yeah. So if we do move on to the US, so Kraft Heinz, I'm sure it doesn't really need any introduction. Most people would be familiar with the products probably wherever they are in the world, certainly from, well, baked beans to Philadelphia cheese, Dairy, or Jello. Well, there are lots and lots of brands which are probably more familiar in the US, but, you know, some of the big ones are, you know, global names. So they had, it was a couple of months ago now. So actually in February, they had their fourth quarter and full year results for 2020 out. And for the fourth quarter, they had net sales increasing 6.2% to $6.9 billion. Gross profit up 19.7% to $2.52 billion. Driven by sustained growth momentum in retail, partially offset by ongoing weakness in the food service side of the business, and a negative 1.4% impact from the exiting of the McCafe licensing agreement. Price increased 4.8% percentage points, reflecting favourable trade expense timing versus the year ago period. Lower sales on promotion during the holiday event periods relative to comparable to the prior year, primarily in the US, as well as reduced promotional activity in capacity constrained areas to better safeguard customer service. Volume was up 1.2% from continued at-home consumption growth, in part due to the COVID-19 pandemic. And it was partially offset by food service declines. They commented that their adjusted earnings per share increased to 80 cents, up 11.1% versus the prior year, primarily driven by adjusted EBITDA growth that more than offset an unfavorable non-cash impact from lower amortization of prior service credits with other expense and income and higher stock-based compensation expenses versus the previous year, as well as higher taxes on the adjusted earnings in the current period. Adjusted EBITDA increased 14.3% versus a year ago period to 1.8 billion, including a favorable 0.2 percentage point impact from the currency. Excluding the impact of currency, adjusted EBITDA growth was driven by pricing gains, productivity efficiencies, favorable mix, and volume growth relative to the prior year period, partly offset by higher supply chain costs, including COVID-19 related expenses, as well as incentive compensation and significant investments in the marketing and sales. Net cash provided by operating activities increased to 4.9 billion in 2020, up 38.7% versus the prior year, reflecting adjusted EBITDA growth, as well as favourable changes in the current liabilities, primarily due to the timing of payments. These factors, together with the lower capital expenditures versus the prior year period, resulted in free cash flow of 4.3 billion in 2020, up 55% to the compared to the previous year. So for the full year 2020, sales were up nearly 5% to $26.1 billion from $24.9 billion in 2019. Gross profit up $9.1 billion, which is 12.6% on 2019. And they've guided going forward for 2021 based on the performance to date. The company believes a flat to positive growth in organic net sales and low single-digit constant currency adjusted EBITDA growth versus the prior year period are reasonable expectations for the first quarter of 2021 performance. The company also notes that this performance takes into consideration comparisons with a strong first quarter in 2020 period that included approximate 6 to 7% percentage point contribution to organic net sales growth and an approximate 9 to 10% point contribution to constant currency adjusted EBITDA growth versus the first quarter of 2019 due to an increased consumer demand related to the COVID-19 pandemic. And their chief executive, Miguel Patricio, said, "Our people's unwavering commitment during this pandemic has been remarkable, and through it, our organization has rediscovered its agility. This has accelerated our transformation and led to the strong performance that we are reporting today. We set our multi-year transformation plan this time last year. We exceeded that plan in 2020. We are increasingly confident that we will again exceed that plan in 2021. We've started the new year with our new operating model fully in place. We have momentum at our back. We are well prepared to meet the uncertainties of this dynamic environment, as well as the challenges facing the consumers we serve." Sam, what do you think of Kraft Heinz as a business?
It's got some solid brands. It's got a lot of debt, hasn't it, though?
It does. And yeah, do you want to talk a bit about the debt?
Yeah, so it's got a market cap of 49.5 billion, a total debt of 29 billion. I struggle to value it because the earnings have been so lumpy. I don't know what a normal year actually looks like. I used 2019's earnings and got a 20p ratio of 25, but I mean, it was still not in great shape in 2019, so I don't know if that's unfair. So it's difficult because you need to have an idea of where the earnings are going to get to when they've finished sorting the business out. So it could well be that it's actually trading at like a forward PE of more like 15 times earnings, but I couldn't really find anything too definitive on that. I mean, Unilever's at about 17, so unless 17 or 18 now, I wouldn't pay a higher PE ratio than you can get Unilever for, because Unilever's in much better shape. So yeah, for me, you'd have to be looking at it at a forward PE ratio below Unilever's for it to be of interest. And even then, I'd probably still go with Unilever.
Well, I suppose it's a relatively new company in that it being Kraft and Heinz together, that only happened sort of back in 2015.
Well, you can get it cheaper than Buffett bought it. So that's one of the pluses.
You certainly can. And I mean, I suppose that really puts it in context because it was peaking back in 2017 before the accounts were, the accounting practices were being queried. And, it was then trading at about $91 a share. And it dipped to as low as sort of low 20s at the sort of peak of the pandemic. And now it's about $40 a share. It's got a dividend, which was, slashed, but it's currently yielding about 4%. And I think, like you say, the debt is a concern. And they have recently announced the sale of one of their nuts business, so the planter business with Mr. Peanut. They sold that to Hormel Foods for 3.35 billion in cash. But, it is still very high.
I suppose if they've got a forward yield of 3.99% now, that is maybe an indication that, for example, it's not going to be yielding 4% and trading at a 25 PE ratio. So where I've used those 2019 earnings, they must be too low to what it could earn in a normal or a good year. It's just getting that figure. But so maybe it is at something like 15 times it. But yeah, for a US company to be giving you that kind of dividend yield, that shows you what people think of it.
Yeah, and I think I think the attraction with it is, and the chief executive, I think he came from PepsiCo, but very highly rated for the turnaround. And it's got those brands. It's the portfolio of brands, I think. It's got, huge strength in those. So I think you would be taking a risk with it, but I think it could be, a value play that might pay off for you. I don't know whether you'd agree with that, Sam.
I do agree. It depends on the valuation. I think there's no question in the brands. I mean, there's brands I was looking at the list of brands today, and there's brands that we don't have in the UK that I still recognise, and that saying, like, I've heard of Jello and I've heard of Kool-Aid, despite having never had it. So that, I think that does speak to the power of those brands. I think with those brands, they will be fine. It's just not overpaying that's the issue, isn't it?
That's right. While you say valuation difficult at the moment in terms of what the normalized earnings might be, is it a company that you'd take a punt on, or do you think better out there and that being a reason for not investing?
I mean, it's not the sort of company I'd go for anyway, just because I think the growth's probably a bit too low. But I'd be buying Unilever before I bought Kraft Heinz every time. Fair enough. I don't know if I'd want to add Kraft Heinz if I could add more Unilever, even if I already owned Unilever.
No. And I suppose the other thing, just to look at it from a tax point of view in the UK, you'd be paying, at least 15% in dividend withholding tax. And if you saw this as a bit of an income play as well, that might be something that you consider.
We don't give tax advice, so you've got to pay for that.
No. Well, just in my own capacity, that would be something that I would be thinking about.
Yours is outside of ISA, isn't it? But if it was inside of ISA, you'd still have the withholding tax.
You couldn't get around the withholding tax, and that's the withholding tax if you've filled in the form and submitted it. Yeah, exactly. That's it. Thank you, Sam. So and you can't get around that inside or outside ISA. So I suppose if you were to look at it and you didn't have a consumer goods stock, it might be something that would potentially sway you, everything else being equal.
Yeah, and then there is also the exchange rate as well. That's another risk you don't have to take with Unilever.
Yeah, exactly. So there are a few things, but no, I quite like it, and I'm probably a little bit more bullish on the direction that it might go in the turnarounds that I think is probably on the cards. But that'll be something we'll have to wait and see, I think.
So of the 6 companies we've talked about today, ASOS, Deliveroo, Dechra Pharmaceuticals, Hotel Chocolat, D Wetherspoon, and Kraft Heinz. If you had to buy one, forgetting what you already own, which one would it be?
Ooh, it's a difficult one. I would probably go for Kraft Heinz. The Dechra Pharmaceutical, that's it sounds very promising. I just don't know enough about it. And then if I were to choose, just from the UK, I might go for Wetherspoons. I'm a loyal customer, and I think the direction that we're going in, it could really pay off Wetherspoons, despite a couple of concerns we mentioned earlier.
Okay.
What about you?
I'd go with Dechra Pharmaceuticals. In reality, I wouldn't invest in any. I wouldn't buy any of the companies. So that eliminates the problem of not understanding Dechra. But out of the ones we've looked at, Detra's caught my eye the most. To me, it looks like it'd probably be the most investable if I were to put the time into understanding the pipeline and the products.
Yeah. No, I think that's the difficulty. If you're a private investor, coming up with the time to be able to cover so many companies or look at them in the depth that you'd like to provide a thorough analysis is always challenging.
Yes, much easier to just put it in the too hard pile.
Yeah. Or you buy the index, but that wouldn't make the show very fun.
No.
Well, I think that's it. We don't have a book review this week, but we'll see you again shortly.
Yeah, we've got it's probably worth mentioning, this weekend we'll be interviewing Investment Talk, who you might follow on Twitter. So I'm expecting him to be excellent based on his Twitter and his Substack. But that's going to be in the same format as the Flosser interview. So that should hopefully be out on Sunday, but it'll be Monday at the latest. So it won't be a normal episode this weekend.
If you do have any questions for Investment Talk, please tweet at
TIW Tweets is the username. So yeah, if you send us a tweet, we can. If you do it soon, we can potentially still squeeze your question in. But obviously, the later you leave it, the lower your chances are. Right. So
fantastic.
I
Look forward to that.
Right. I'll see you next week then.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.